Hey you guys, this is Cindy Barnett, President of GPS Wealth Management, and as you know, yesterday was a pretty steep loss in the stock markets, and so I just wanted to give you guys a quick update. This correction began last Friday on February 2nd and has proceeded to drop even through today. As I speak right now, Friday the 9th, we are down in the Dow Jones 153 points and down in the S&P about 11 points. So let me just give you some quick numbers, okay? As far as the Dow goes, the Dow is down 10%, a little over 10% from its high in January. The S&P 500 is also down around 10% from its high in January. We're down from for the year, we're down about 3.5% in both of those indexes as well, and the VIX, which is the measure of volatility, is up by 25%. So whenever the VIX is up, that causes a little bit more commotion and volatility in the market, and so it kind of feeds itself in a way. So here's the thing I want you to be aware of. The last two corrections that we had, one in August of 2015 and the second one was in the first quarter, January of 2016. Both of those lasted about 3 months. If you'll look at this graph behind me, right here we're looking at the third quarter correction. This is driven by oil. All right, so it lasted about 1 quarter, and then right after the first of the year, now this is our election year, okay, and there was a lot of fear and unknowns going into that year. We had it was about another 3-month correction. So I just want you all to be prepared that this correction could last as long as 3 months, even though our general fundamentals for the U.S. markets are pretty good. So let's just look at this. So for the S&P 500, over 304 stocks have hit new highs in 2018. And out of those, over 170 stocks have fallen over 10%. So in the 10% bracket, you're looking at Netflix, FedEx, Apple, Pfizer, Alphabet. Alphabet is Google. All of those are down more than 10%. In the 20% category, Invisalign, so the company is called Align, that's the dental company, they're down more than 20%. Hess and Ford are both down more than 20%. So one of the things that I'm getting asked frequently is what's driving this correction. There's several things that are driving it right now. So number one, we were expecting the Federal Reserve to raise rates about 3 times in 2018. And now with the new Fed chair, we're expecting rates to raise more frequently than that, 4 times, maybe even 5 times for this year. The markets don't like that. Okay, so first and foremost, that causes borrowed money to be more expensive. So a couple things to think about. So this is affecting the bond market. There's a lot of fear of inflation coming down the road. In addition to that, the tax cuts that we just received, those are all financed through additional debt. That causes some big concern with paying the interest on our national debt. So as rates start to go up, that's going to affect the amount of interest that we have to pay for financing these benefits that we have. All right, so in addition to this, there's a lot of institutional investors and some high-end investors that they have a lot of leverage in their portfolios through some of the strategies that they use, and because of this concern on rates, there's a lot of what we call deleveraging of some of those. So a lot of those particular investments are starting to unwind. They're getting out of them. They're starting to dump those stocks, and they're implementing their long positions and deleveraging. And so what that means to us is there's a high frequency of trades going on. Another little impact that has happened in the past is as we start to see frequency of trades, our New York Stock Exchange and our exchanges are all computer-based trading platforms. So when there's a certain volume or certain stocks fall to a particular point, that'll trigger some automatic, basically you can call it robo trades, where the computers just start to sell and sell and sell, and that frequently can cause a real quick downfall in the market. And sometimes even in the past, you may have heard it where the stock exchanges have put that literally ended trading because the computers have just like dumped so much stock. So that's part of it as well. So we expect that there will be some fear. Well, there is fear regarding increasing rates. It is affecting the bond market. It is driven more and more by fear of inflation and how we're going to pay for our ongoing interest on the debt that we owe. So it's going to be interesting to see how this all pans out and how long this correction actually lasts. But there's definitely some overpricing in some of the sectors of the market, and so the key thing is to make sure that you're well allocated and to stay calm and stick to your plan. Okay, so again, if I can help you in any way, give us a call here at the office, but in the meantime, be calm and carry on. This is Cindy Barnett. Talk to you later.